Hello everybody and welcome to this latest Avalara transactional tax webinar. This one's covering the huge momentum building around taxing of digital services provided to consumers. And as you'll see, 2020 is a record year for new VAT and GST regimes being rolled out. And more threateningly, tax negotiations around this whole area globally breaking down. And I'm Richard Asquith, VP of Global Indirect Tax in Europe at Avalara, and I spend my day worrying about the future rules of VAT and GST globally so that you and our automation engineers developing tax software for you, or our Avalara tax experts helping you in turn with your outsourced VAT registrations and returns, don't have to and are getting your tax done accurately and on time. As always, please feel free to ask any questions that you may have through the Q&A section of the login, and there's a couple of people standing by to help you with those questions. We are also making available for you in the resources section of the login a link to download a free guide on the 87 jurisdictions that have implemented or are planning to at least VAT, GST or sales tax on digital services. And whilst today we'll also be talking a little bit about digital services tax, DST, today, and that's the turnover tax on digital companies selling around the world. The details of those will be in a separate guide coming your way in the next few weeks. So 2020 is another hiatus for taxing digital services. We will hit a record whopping 11 new implementations this year, taking us to 71 jurisdictions in total. And that number includes all the EU 27 plus the UK and the US. We then have a further 16 coming with definite plans for next year, 2021, or soon afterwards. I am cheating a little bit, I should say, with that number, as I've included post-Brexit UK, which is exiting the EU digital services inner circle at the end of this year, but more about that later. The numbers involved are really big, as we've already seen, and that's why there is this rush, particularly at the moment with COVID. EU's making around about, give or take, 3 billion extra per annum, and that's rising fast on VAT. Australia is raising at least $500 million Australian dollars a year since it launched its version of all this, from just 400 overseas businesses paying GST, way above their own expectations. And tellingly, 36% of the revenues are from just the top 5 platforms in Australia. As you'll see later, there are about 26 countries that have implemented or threatening to launch DSTs, and then the EU's wide plan may have to be added to that number too. Right, what's on our agenda? Well, I'd like to breeze through some of the common traits. What are the digital services and the compliance basics for VAT and GST regimes? But I'll leave the details to the download guides, and then I'll talk about some of the more fruity marketplace liability and tax collection methodologies, including withholding tax. We can then pick up some of the more topical issues, looking briefly at this year's newest entrants into our country tracker, plus what the UK is planning for 2021 after full Brexit, and how things work in the US. And then lastly, as I was saying, a quick intro to what's going on DST and why the tax world is threatening to kickstart a new war. Now, as we delve into the differing compliance and collections regimes today, you will see some recurring best practices, and a lot of the credit for this, I think, goes to the OECD, which, in addition to supporting its 37 member states, works with over 100 other tax regimes around the world who have been anxious to capture their share of digital services tax revenues. And at the core of their work that it does in this area are 4 recommendations. So firstly, creating an effective legal basis for the right to tax non-residents selling to their consumers. And that's all based around the residency of the consumer. Then implementing an efficient and effective collection mechanism with simple registration, collections and reporting requirements, as you'll see as we proceed. And that includes around VAT registrations or withholding VAT. Then thirdly, leveraging the information and the unique position of marketplaces for the VAT collection process. And then fourthly, strengthening enforcement with the implementation of cutting edge risk-based compliance technologies, which is then backed up with administrative cooperation between the different tax jurisdictions. So what's in scope for all of this? Well, digital or electronic services, as they are sometimes called, typically targeted with VAT are those accessed by consumers via the internet or some similar digital networks. And the overriding criteria is that there's no manual intervention. It must be an automatic service process. And you can see up in front of you now a fairly comprehensive list of the common types of supplies that are listed by legislation. And it's almost more helpful to say what's not in. So some services which should not be considered digital services are things like DVDs or memory sticks with content. Anywhere where there's professional advice given via email is out. Offline data services or tickets bought for live events, theatres and restaurants, they're certainly not digital services. And anything around e-learning which actually involves some sort of live teaching element is excluded too. And in many countries, obviously European Union is the big example, broadcast and telephony services are brought into the tax net too. A few countries though, notably the US, have dedicated communications taxes. So it's worth keeping an eye out for those, as they usually aren't levied at the federal level. But many of the new countries in Asia and South America that we'll be talking about later haven't included these. Again, all the details are in the guide on each country, so I'll move on quickly. Now, the next big question, once we've established what we're going to tax, is where to tax. So what's required to determine and prove in which country the VAT is due, as it's a consumption tax, it should be, obviously, tax is due where the service is used or at least purchased. For digital services, countries have been demanding that providers collect and use and store some mix of the list you see now as proxy determinants for the place of supply and therefore taxation. And typically there has to be at least two of these pieces of information, and they obviously shouldn't conflict. But after initial struggles over this, particularly around the European Union back in 2015, and the disproportionate costs involved, many countries, the newer ones, are relaxing this and moving to just one piece of information, especially for smaller businesses. There's often a threshold below which less evidence is required. And on the compliance side, I think it's really good progress, particularly under the auspices of the OECD, on simplifications. Since foreign providers require less VAT rights, notably obviously the option to recover local input VAT, then governments are increasingly simplifying the registration and returns process, and their aim is to remove many of the bureaucratic or language barriers that hinder honest foreign sellers in complying and paying tax compared to the traditional VAT compliance process. And so this includes fewer data points and digitized transaction exchange. And countries like Australia, I think in particular, have shown the revenue benefits of this approach, and it's being copied worldwide. Another point while I look at that list of simplifications is the obligation not to have local bank accounts. And a limited invoice obligations too is important, because these are challenging if all countries require it with varying requirements. Now let's look at how tax authorities are co-opting marketplaces into the whole VAT collections role. In their eyes, digital platforms have really enabled millions of offshore providers to sell billions in revenues in their territories, often without proper consideration to consumption taxes, which is obviously lost tax revenues, but more importantly, perhaps unfair competition on local online and offline providers. But actually, the marketplaces are also the sensible place to start, since they have most of the data to hand, and they are cooperative. They just ask for consistency across the jurisdictions, and that they're only asked for the minimum data set for the fewest number of times from their sellers. So first up, full liability, and that's really where the marketplace is controlling the T's and C's and the payments. The marketplace therefore becomes the provider from a digital perspective, so takes care of the charging, the invoicing, collecting, reporting, and indeed remitting of the taxes. Then split payments, where the marketplace is mandated to withhold the VAT element of the remittance to the seller and pay it directly to the tax authorities instead. And this is very popular in the US following their 2018 Wayfair versus South Dakota remote seller ruling in the Supreme Court. It is problematic, though, as we'll touch on later, because of variable VAT rates, not being able to identify exactly the place of supply, etc. So there can be over or even double taxation. Also, tax authorities can think about due diligence, where they impose upon the marketplaces basic compliance checks like, does the seller on the marketplace have a valid VAT number? It's important to give good education online in support to sellers by the marketplaces, giving them a clear guidance on what their VAT or GST responsibilities may be. And then more advanced, you could be thinking about actual compliance assistance. So the marketplace can offer direct VAT registrations and compliance support, as one or two of the largest marketplaces in Europe do, or just simply recommend a few outsourced VAT compliance service providers. For the more conservative countries, many have been imposing VAT withholding obligations at various points in the supply chain. So that's mandating a particular targeted party to split the VAT due and pay directly to the tax authorities. So this means the underlying provider never receives the VAT, and there's no possibility for VAT evasion. This has been very popular in South America, in places like Colombia, which uses it as a backup for providers who opt for it instead of getting VAT registered. And it does give the advantage of apparent safety, but it is complex, as I think I mentioned earlier, to administer and very easy to avoid. So other options, marketplace split payments, which I already mentioned in the last slide, or payment providers who are acting as the financial intermediary. So the payment processor identifies a sale by a foreign provider of a digital service to a local consumer and withholds the VAT or GST element. So thinking of Argentina, and can also apply to domestic transactions. Now, the payment provider can include credit cards, both the merchant or the issuer, bank transfers, money wallets, or crypto currencies. And this is where the problem in this method lies. It's really the proliferation of hundreds now of payment providers. So it's impossible for tax authorities to know who to be targeting. A number of the countries do provide prescribed lists to the digital providers and marketplaces of payment providers to apply this measure to. But this, again, it's difficult to administer and keep up to date, and often leads to inaccurate under or over charging of VAT. And then lastly, the customer, the final recipient of the digital services, can be mandated to withhold the VAT themselves and declare it and pay it through local tax authorities. So that's the position in China, has been in the US, but has contributed to a lot of tax evasion. Right, now we've covered the common compliance issues. Let's look at a few country specifics and what's going on in over the next few years. And here's another reminder that the details are all in the guide, which you can download. It covers the 71 jurisdictions that have completed by the end of this year, their rollout, plus 16 with plans for next year or in the near future. And as I've said, this year it's a record of new implementations, 11 versus the previous record of 10 back in 2018. And of course, COVID is the great catalyst for this burst of energy. So calling out a few of the interesting ones, firstly, Chile. which has just imposed 19% VAT from June. And they've made registrations really, really easy for foreign providers with simplified online scheme. And indeed, Chile was originally planning possibly a harmful digital services tax, which I'll be talking about later, but was talked off the ledge and instead has gone for VAT. Indonesia, which is putting 10% on digital services from the 1st of August. It did get delayed by 1 month. India it's taken the route of naming companies, digital providers, which are required to register. And so far it's 6, and they'll be approaching all the larger players. It's probably got a probably high registration threshold of about 600 million rupees. So that's about over 40,000 euros a year. And there's a novel second registration threshold if the platform generates annual traffic of at least 12,000 users. In Mexico, which requires, in addition to VAT, there's also an income withholding rule on non-resident providers of digital or gig and sharing type economy services. So foreign platform facilitating services like ride sharing or house letting are obliged to withhold a proportion of the income due to a Mexican resident provider on the services. And rates really vary according to the type of service and the income of the provider. And remember, for Mexico now, it's B2B2 with no reverse charge, and so requires a sales invoice. And then lastly, not on our 2020 list is the Philippines. And that's a great example, fired by COVID, of announcing in the past month or so the implementation of VAT on digital services and hoping or expecting to be launched this year. But they've only just realized, I think now, that the planning, the consultation and the implementation process is going to push them at the very least into 2021. I wanted to touch on very, very briefly the European Union's scheme for reporting all 27 member states' sales under a single quarterly return. So that's the MOS, the mini one-stop shop. And this still includes the UK, which I'll touch on in the next slide. So MOS was introduced back in 2015 for the new rules on taxing in the country of the customer. And it's available to non-EU providers too, who can register in any country they choose under a variation called the non-union MOS. Well, it's just a short update on this. The scheme's being extended to B2C sales of distance sold goods from the 1st of July 2021 as part of the EU's e-commerce package. So whilst there are no country details, it should go now, the MOS reporting will go into a new return called a one-stop shop OS, which will include distance selling of goods, as I just mentioned. And of course, you cannot escape any Avalara WebEx without Brexit creep. So the UK is out of the MOS scheme on 31st of December 2020 as the transition period comes to an end following the 31st of January 2020 exit of the UK from the EU. And the deadline for the last payment of UK sales via MOS by non-UK sellers is the 31st of January 2021. So such providers must then instead use the regular UK VAT registration and returns process. And HMRC, it's expected, will soon start accepting registrations for digital services. There's no UK VAT registration threshold for foreign businesses, and there's also no simplified, so far anyway, UK VAT registration process for digital services compliance. So taxpayers will be obliged to follow the existing application and subsequent returns process. UK and non-EU providers that have been using a UK MOS to report their EU 27 digital sales will also have to now re-register somewhere else in the UK by 2021, and this will be under the non-union MOS scheme. Now, some words on the US sales tax rules for digital services and goods. In short, it's a confusing mess. Firstly, for any suppliers in the US, as I'm sure many of you know, there are over 13,000 taxing jurisdictions because there's no federal level sales tax VAT. So sales tax is a turnover tax operating in the US, which means that all the states, counties, cities, and various municipalities can charge whatever they like. So there are around about 30 states that now levy sales tax on digital services out of the 45 plus Washington, D.C. that have a sales tax. Most include now foreign or remote sellers, as they're termed, following the 2018 South Dakota versus Wayfair Supreme Court case. But they do tend to have narrower definitions of what is taxed and what is a digital good or service. And they tend to pick up the electronic versions of physical goods and not necessarily intangible personal property. So think electronic books compared to published equivalents. But this is fast extending now to streaming or download media. And COVID, again, is the big catalyst here, like the rest of the world, as states struggle to a loss of sales tax from regular consumption. Anyway, but the definitions are definitely confusing and open to interpretation across the different states. If you are looking for help on that, understanding the taxability rules in the US, then do contact me or anyone at Avalara, as we have a hugely comprehensive sales tax calculation tool for all those 13,000 jurisdictions. Indeed, obviously, for the rest of the world too. Right, now a few slides and comments on digital services taxes, and that's the new turnover taxes being threatened on the big digital giants, since these are often used instead of or perhaps confused with VAT on digital services. So I'm sure, as you'll know, the current corporate tax regime was initially agreed back in the 1920s, and it's all based on the traditional in-country physical presence assumption. So it is simple for tax authorities to spot who should be paying tax to whom. And it was really built around two stalwarts. Tax where based, corporate income taxes are due where a company is located or resident. And then to supplement that, transfer pricing controls on cross-border transactions, and that's to stop the manipulation of prices and therefore profits by related companies not charging fair or arm's length pricing. And digitalization is just bypassing these canons. Digital services obviously can be sold across the world without a local presence, which causes the erosion of the tax base of countries. And then digital intangible assets, data, and income from them can be easily shifted to low tax jurisdictions. So the outcome is large scale erosion of countries' taxable base, plus the shifting of profits offshore to reduce companies' tax liabilities. So digital services taxes fill the gap, and public resentment around this issue and governments' need to raise COVID-19 funding has spurred them into action. So a new class of turnover tax, DSTs, is being implemented. And these typically target large tech giants from the US and increasingly from China, which have benefited from the failure of the existing global tax settlements. And so typically they tax advertising, sales of consumer data and access to digital interfaces. So that can include marketplaces for selling or buying goods or services. And they're charged on the providers of the digital services by the country of resident of the consumers, even if the provider is located resident in another country. And this is opposed to VAT on digital services, which is a charge on the consumer, but collected by the provider. However, the structure and the scope of DSTs mean they will largely target the US media tech companies. And the US, therefore, considers them as discriminatory, in particular the high multi-million dollar thresholds, which the DST countries have been proposing, which means it keeps the local digital companies out of the tax net. So it's unfair on the US businesses. And as a result, the US President's offices has just formally launched investigations into several countries' DSTs in June. And if that investigation does find against those taxes, then we can expect retaliatory tariffs to follow. Now, keeping most of these taxes still on pause, or in countries like the UK and France, where they have been implemented but are not yet being collected, is the ongoing discussions between the 140 odd countries at the OECD. And at stake is about 100 billion in taxes, according to the OECD's estimates, but it's struggling. Not helped, obviously, by COVID interruptions. And these talks are structured around two pillars. So number one is the right for countries to tax digital sales in their country if it's to the consumer, even if the provider is not resident. And this would be mixed with some element of profit still being taxed in the country of residence production. And this is the one that's making decent progress of the two pillars. Now, pillar two, much more controversial. It's a minimum global tax rate for multinationals in the country of their residence and or where their profits are being recognized. And that's to limit the incentive for businesses to shift profits, their digital assets, to low tax jurisdictions. And so aside from promoting a relocation of taxes, this would also level the playing field for small businesses who cannot move their businesses or profits between jurisdictions. And this pillar two is giving a lot of problems, particularly when it's striking the right rate. There's talk about a 10% minimum rate. And the problem there is a lot of assets and jurisdictions, their tax rates are well below that. Typically, the digital asset may be held within a special tax reducing patent box scheme. So the US is regularly threatening to walk out on these talks, and it's just done so again a couple of weeks ago. And so it's probably now less than a 50-50 chance that we'll get a deal in time for the self-imposed limit by the OECD of the end of this year. So that does mean that there's a high chance that a lot of these already announced or proposed DSTs will go ahead. And we will, at Avalara, will be sending out shortly a full guide on DSTs, the ones that have been planned, implemented, or at least talked about. But the headlines are, the EU's 3% DST is on pause, waiting for progress on the OECD. But in Europe, the UK, France, Greece, Austria, Hungary, Italy, and Turkey have gone ahead, albeit with pausing on collections. And there's several other EU countries like Belgium and Spain, and they're ready to move if there's a lack of progress at the OECD. And then in the rest of the world, there are variations on this now in places like India, Brazil, Kenya, and Indonesia. And many countries like Australia are merely in pause. On top of that, many countries too have introduced effectively a digital withholding tax, if you like, on this type of taxable supply. Right, that's it for this WebEx. A lot covered, but the details are in the supporting guides. And as always, feel free to drop me an email with the address you can see on the screen if you have any questions. Our next one, and there will be details on the next screen, is around cash flow saving opportunities for VAT during COVID. So plus an invite is coming to Avalara's virtual digital VAT summit Inspire, which has a truly amazing roster of speakers from tax all around the world. So in the meantime, thanks again from me. Stay safe and stay well.